Financial Accounting, Chapter 15. Introduction. Foreign currency translation is the accounting method in which an international business translates the results of its foreign subsidiaries into domestic currency terms so that they can be recorded in the books of account. The foreign entities owned by your business keep their accounting records in their own currencies. To apply the appropriate method of these investments, you must translate the financial statements from the foreign currency into domestic currency. Transactions. A transaction is a completed agreement between a buyer and a seller to exchange goods, services, or financial assets in return for money. In business bookkeeping, this plain definition of transaction can get tricky. A transaction may be recorded by a company earlier or later, depending on whether it uses accrual accounting or cash accounting. Translations of financial statements. Translation accounting is the process used to turn foreign functional currency financial statements into U.S. dollar-denominated financial statements for consolidation and reporting purposes. Transaction accounting is used to report on non-functional currency activity and balances on functional currency books. Each has its own unique rule set. Revenues, expenses, gains and losses be captured at the rate on the date the activity is recognized, but recognizes that as generally impractical and provides for a practical expedient. Most corporations translate the entire income statement of a foreign subsidiary, including revenues, expenses, taxes, and other income, all at an income statement rate, ISR. That ISR is generally the simple average of market rates for the month or the prior months. Balance sheet rate, either of which provides a month's entries at a rate relevant to the month, and a weighted average rate for the year. A numerical illustration. The accounting equation is a basic principle of accounting and a fundamental element of the balance sheet. The equation is as follows. Assets equals liabilities plus shareholders' equity. This equation sets the foundation of double-entry accounting and highlights the structure of the balance sheet. Double-entry accounting is a system where every transaction affects both sides of the accounting equation. For every change to an asset account, there must be an equal change to a related liability or shareholders' equity account. It is important to keep the accounting equation in mind when performing journal entries. For every transaction, both sides of this equation must have an equal net effect. Below are some examples of transactions and how they affect the accounting equation. Explanation. 1. Purchasing a machine with cash. Company XYZ wishes to purchase a $500 machine using only cash. This transaction would result in a debit to equipment plus $500 and a credit to cash, $500. The net effect on the accounting equation would be as follows. This transaction affects only the assets of the equation. Therefore, there is no corresponding effect in liabilities or shareholders' equity on the right side of the equation. 2. Purchasing a machine with cash and credit. Company XYZ wishes to purchase a $500 machine, but it only has $250 of cash in its holdings. The company is allowed to purchase this machine with an initial payment of $250, but it owes the manufacturer the remaining amount. It would result in a debit to equipment plus $500, a credit to accounts payable plus $250 and a credit to cash, $250. The net effect on the accounting equation would be as follows. This transaction affects both sides of the accounting equation. Both the left and right sides of the equation increase by plus $250.